Welcome to the Rigatoni Capital podcast. I'm your host, Colin. It is the morning of March 23rd, Monday, and it is a very dark and gloomy and rainy and sad day here on Wall Street. I think President Trump, woke up this morning and realized that this could be a very ugly day on Wall Street. Looked at the weather, saw it was doomy and gloomy, and decided to make this announcement that he'll postpone further strikes on Iranian energy infrastructure. And we saw a sudden spike in risk on stocks. We saw the VIX drop, and we saw WTI down about 3% just within like an hour. And so not much else to discuss here on the geopolitical front. I think the most important story before this story over the weekend was still kind of going through what happened in Qatar in terms of the Ras Laffan strike and how that would hurt LNG exports and LNG in general. And then we found out that obviously this kills helium production, and God, Qatar has 34% of helium production, and it just shows you how we are so dependent on Qatar's role in helium and how this obviously can impact semiconductor stocks. And this is a post from Zero Hedge, and everybody's done their post already about how this hurts semiconductor production. And obviously it's true. It's just that I think that we're still at fog of war. And here you see Asian chip makers on edge. The war highlights the sprawling global supply chains that underpin South Korea's semiconductor industry, which has a surge in global demand for its chips and amid the AI boom. We know about that. We know about SK Hynix, Samsung, how it says they're particularly vulnerable to supply shortages because it imports about 65% of its helium from Qatar. So this story is now old news because now it's Monday morning. That story's from over the weekend. But a lot of these, like the Kospi before this news in the morning about Trump holding back on the energy strikes, is the Kospi was probably had a really bad night last night. And we can look at that real quickly. That market is probably closing now. It says the Kospi was down 6.49%. Okay. So yeah, I'm guessing this was, let's go back to 5 days. So as of Friday, March 20th, you can see when things opened up today, March 23rd, you can see we had another leg down in the Kospi, okay? There's a few key things that matter, and it's earnings growth, right? If you own individual stocks. And then we're going to talk about maybe regional investing, like not being afraid to sell in and out of your US stocks. It's very popular to sound smart and say, I think this part of the eastern part of the hemisphere, Asia, this, that is a better place to be in terms of US. US is going downhill. I'm moving my investment over here and there. And my point is, like, no, the U.S. stock market is the S&P 500 should continue to return an 8 to 10% annual average return for the next 10 to 20 years, even while we're in this Cold War with China. And that will, even if the U.S. loses the Cold War in China, the point of the post from this morning, which I'll just show you right now, the U.S.-China Cold War portfolio was, even if China wins, the argument is that the U.S. would maybe have more of a soft landing. It's not like they're going to go out of business overnight if they lose the Cold War. China wants to see a prosperous U.S., and that the U.S. is one of their largest consumers, if not their largest consumer, export consumer. So they don't, maybe you see something like a 5 to 7% annual average return in the U.S. The problem is the U.S. has built some kind of a moat, and I didn't talk about that moat here on this post. I kind of just didn't want to dive into the money printer. I didn't want to really dive into Palantir and defense spending. I didn't really want to run into how the U.S. talk about how the U.S. will still attract talent because the best companies are still here. Obviously, they're still in California too, like Silicon Valley. And I just didn't want to get into that too much on this post. The point of the post, if you can see it, hopefully you can, was trying to just give you the idea that, hey, if you agree that we're in the US-China Cold War portfolio, these are the three investments, kind of like the three main investments that you kind of anchor your portfolio to. And I think it's pretty boring, those three type of investments, but look at this photo here, guys. I'll never forget this, and I'm sure you don't either, is when President Xi and his wife went to visit Trump at Mar-a-Lago in April 2017. And I probably remember it because it was in Palm Beach, which I like Palm Beach area really a lot. And if you remember, Ivanka's daughter sang in Mandarin to President Xi and his wife, and people are going to say, "Oh, they look like they were friends." I think they were friendly. I think they still are friendly competitors. You know, President Trump hopefully doesn't have anything personal against President Xi, and President Xi hopefully doesn't have anything personal against President Trump, but they are competitors, right? Because we have this superpower in the US, which has been the main superpower, the number one superpower for the last century. And then you have China, which is trying to rise to the top. Anyway, the point of the post, again, is kind of explaining to that idea where the financial media tends to overcomplicate the regional allocation question with macro arguments that sound sophisticated, but ultimately get overridden by something much simpler. We all we hear about is currency exchange dynamics, interest rate differentials, and current account surplus debates, and the tariff war, and this and that. Really, I think it's simple. Like usually, you want to invest with the bully. And Lit Nomad on YouTube is the one that inspired this post for me. If you want to check it out, it's under Lit Nomad on YouTube, and he kind of inspired this idea for me to write this post that came out this morning on Monday. And I agree with mostly everything he says, and then I kind of just put my spin or my add to it. So like if I were investing, the three investments for a world without a clear winner. And remember, this Cold War should take 10 to 20 more years at least, in my opinion. It can be a hot war in certain areas of the world or whatever, or proxy wars can break out. But really, it is a somewhat AI arms race, Cold War type of war, in my opinion. It's really an economic war. And it just overlaps to aerospace, satellites. I mean, who controls the air usually will win this next Cold War, right? So long story short, I still say, and I think Lit Nomad would agree with this, is that you still own U.S. stocks. You still own the S&P 500. And you're careful, super careful about owning Chinese stocks. And we explain, and Lit Nomad explains like why equities and financial instruments in China are really not a safe investment. And I think the Chinese population that lives in China understands that. They saw what happened to Jack Ma. They see stocks get diluted overnight, and they see government intervening in something that's a piece of paper that says you're a shareholder of a company. It's kind of fake to them. And instead, they may feel more comfortable owning real estate where they live in their house, and they may feel more comfortable owning gold, like physical hard assets. So we kind of, and Lit Nomad, I think, explains it, that we kind of are a little suspicious on trying to pick the next tech winner like an Alibaba or a Huawei over in China. Just be careful. And if that is your way to hedge the US and something like that, that's fine. But I just don't recommend it. And that's because I have been investing this way for a really long time. China is like that seductive woman that's telling you to come over here, and it has such low valuations and they would look so attractive, but the stock is listed in China. I mean, the stock's listed at the New York Stock Exchange too, but the stock is the headquarters is based out of China. If, let's say, Tencent were a US American stock, I mean, I would be buying it because the valuation is so attractive. Like it really ropes you in. And this is the way of the Chinese Communist Party, in my opinion, putting this other risk on top of the stock that people forget about, and people kind of think like, hey, like at least and Stanley Druckenmiller, he's not afraid to buy Chinese stocks, but I think he's more so trading them. And then Charlie Munger wasn't he a big Alibaba shareholder? And so really smart investors that are much smarter than me and they're much wealthier, super investors, they also invest in Chinese stocks. I just decide at Rigatoni Capital, I decide not to really invest there, and I go even an extreme step. I go to an extreme step where I actually don't even like to buy international ETFs because it has exposure to China. That's how crazy I am. And I try to carve out China in all my investments. And for example, I own the Freedom 100 Emerging Markets ETF. Freedom. I'm not going to talk to you about Freedom because every single podcast I've done in the last 3 weeks, I talk about Freedom every day. So if you're interested, you can go to my Substack, which is Rigatoni Capital. And then, of course, I talk about Bitcoin because I always talk to you guys about Bitcoin. Bitcoin, I'm a big fan of. But I respect people that invest in gold and physical gold too. And I say, like, look, if you want to substitute the word Bitcoin with gold in this scenario, that's fine. But I choose Bitcoin, and this is why I choose Bitcoin over gold, and I kind of explain it. So 3 investment ideas, and like in a perfect world, I'll just say, like, look, maybe you go like 60% US stocks. I can't do math. 20% Freedom Emerging Markets ETF, which is carving out China and other autocracies, and then Bitcoin. So it would be like a 60-20-20 portfolio. This is not financial advice. I'm giving you just like a thought exercise here. Do you understand? It's not me telling you where you should invest in. Of course not. I don't know your situation, but check this out. I am a little suspicious of this, and I don't think it's very accurate, but Google did do research on Statista, the IMF, and the BEA, and it was supposed to give me like a combo of those 3 data companies, and it was supposed to give me an accurate presentation of US versus China nominal GDPs, and then US real GDP versus China real GDP. That's what the goal of this photo was. I don't even think this exists online. This is I know it says the forecast is from Statista and IMF. So, they probably took a combination of their forecasting. And then you can see after 2025, the forecast, this is pretty accurate when I'm looking at 2025. I was a little confused. I thought China definitely should be a little bit higher and US should be a little bit lower in terms of nominal GDP, guys, but it actually it's hard to figure out what you're going to make the chart show because these are volatile. The GDP of the US and China are pretty nominal. It depends on a lot of different things, and they're trying to maybe get an average. That's how I took it. And then you can see like by the year 2033, in between 2033, the year 2033, China eventually overlaps the US in nominal GDP and becomes the larger GDP country. And then the US, the US looks like it continues to grow. And then you can see with the real GDP, which takes out inflation, right? You can see that it looks like that the US is more competitive in this scenario. Like China might not overlap the US in real GDP until late 2030s. So that's the difference I took. Again, this is just a forecast. Nobody knows what the hell is going to go on. I mean, people thought that forecasters believe China would have been a larger country by now, but COVID happened. Things happen. The U.S. continued to have a strong output, and their stock market grew a lot, and they printed a shitload of money during COVID. So we all know that. All right. So this podcast, I'm not trying to make this long because I respect everybody's time, and I'm going to have to break some things up. Like I wanted to go over this little chart. Let's try to do it really fast. I'm going to set my timer. Set timer for 8 minutes. Studio Innovation on Substack, one of my favorite follows. He says SPY volume today jumped to the highest since last November's bottom. That was on March 20th, which was Friday. What's funny is I told you guys that my theory was when March Madness occurs and when baseball opening day occurs and MLB's opening day occurs and when the Masters start, that volume drops off. I was obviously very wrong. Very wrong. And then Studio goes over the forward multiples of the 10 largest companies. Apple 29 times, which is surprising that Apple is still trading at that high of a valuation, in my opinion. Amazon 27, Google 20, Alphabet 27 times, Broadcom 24 times, Berkshire Hathaway 24 times, Taiwan Semiconductor 23 times, Microsoft, this one's crazy, 22 times forward multiple, just the next 12 months. NVIDIA 21 times, Meta 20 times, and Saudi Aramco 16 times. And he shows you the picture here. So the point of this is like, I wanted to have a discussion with you today about how I do find once you get to these low 20s that I do believe these stocks are trading at a cheap valuation. The problem is do you want to risk buying Microsoft? I think Microsoft has some serious issues. I really do with AI disruption. But again, look at NVIDIA down here and Meta. I mean, those seem like value stocks to me right now, and I'd be interested. I'm not buying anything right now. I'm just saying, if I'm not in these names, I wouldn't be surprised that you want to buy them. I already own Meta and NVIDIA. I wanted to show you that the S&P has risen so much in the past 5 years that even a repeat of the 1929 crash, the worst in history, wouldn't take it below the COVID lows. Let me read that again. The S&P 500 has risen so much in the past 5 years that even a repeat of the 1929 crash wouldn't take it below the COVID lows. That's like a percentage, right? I hope so. I hope they're not giving me a dollar amount. I don't think they would be that stupid. But the whole point is that, like, oh my God, we printed so much money. We're in a bubble, blah, blah, blah. Yeah, okay. All right. I wanted to show you a photo. Now we're going to go through charts. So for people that are not watching, what I'm going to try to do is read it and explain to you what I'm seeing. We all see Chevron hitting all-time highs. We all see Exxon hitting all-time highs. And we see the XLE, the energy ETF, hitting all-time highs. And the point of that is that Mike on the Investing or Gambling podcast said yesterday, like, this to him means that the energy space is like the safe haven right now. There's the only place to find cover because, like, look, even gold and silver have pulled back significantly. So that we all understand, we all agree with that. Here's what I wanted to show you are all these other charts. I wanted to show you the XLU pulling back very sharply. XLU pulling back that's the utility ETF pulling back very sharply, guys. And I show you something that always goes up from the bottom left to the upper right. These stocks that have looked so attractive for the last few decades. Some of them go back to 1980s, 1970s. Where these stocks just go from the bottom left to the upper right, and like they really don't ever correct. Do you guys know what I'm talking about when it comes to these stocks? We used to have a lot of them, but in the 2020s, in the last 5 years, a lot of them broke that trend. I wanted to show you O'Reilly Automotive, ticker is ORLY, and show you how this trend has broken and why someone like me is very interested in this. Now, for one, it tells me something's wrong with the macro backdrop in the economy. But number two, do I want to take a stab at something like O'Reilly Automotive when it breaks this trend of going up always? Yeah. So I'm not giving you financial advice. I'm just saying this is eye alarming to me. This has got my attention. Another example is TransDigm Group. It finally broke this consolidation trend that we've had, and the ticker, I believe, is TDG. Doesn't look like these charts have tickers on them, so apologize if I'm not giving you the tickers. But we all know TransDigm Group. TransDigm Group is a beast of a company. It's like a large cap stock, obviously. So you should know what it is. And if you don't, check it out. TransDigm Group, look, like had always gone up to the left, to the right, upper right. But look, it really just broke this, slightly broke. It's not a big deal. I'm just saying that we're at the low end of that trading range. Again, I'm not a trader. I'm just saying, like, when do you add to your position? When do you enter a new position? I mean, this isn't looks like an ugly chart. TransDigm, because it broke that support line that has been going on since 2024. It's been in this trading range since 2024. It had a very strong base. This doesn't seem healthy that it broke that support line, but it may just bounce right back. Again, I'm not a trader. I wouldn't try to predict this. That's stupid. Casey's General Stores have, all I see online is Casey's General Store, great stock, great stock. Okay, fine. It is a great performing stock. I don't love the business itself. Maybe I need to go into a Casey's General Store. Apparently I don't have them around where I live. It's more in the upper Midwest area, and they claim like it's as popular as Wawa from my world. So that's interesting. And I know Bucky's down in like the Texas area is awesome, but maybe Casey's is as cool. I don't know, but I can tell you that this stock does not want to sell off. So I don't know. I just put this in here to see like if this was breaking at all, and it's not. Waste Management like showed you that it was in the long consolidation range that it always is in. Waste Management has been in these longer consolidation ranges, and then it has one leg up, and then it has another leg up. And for example, it looked like it was having this leg up in the last few days, and then it kind of sold back off. So that really would confuse a trader. How can you trade this? If you think it's going to break out again and then it does this, what do you just put a stop loss in? This is why I think trading is kind of like a hoax. No, people that sell puts and make an income that way. And there's some people on Substack that are options traders, and I know they are successful. I'm not really talking about that. I'm talking about the retail investor that doesn't have much experience and they think they can read charts to be able to tell them when to trade. That's what I'm really talking about, because this would have faked you out, in my opinion, because you would think it would have this other like higher around 240 per share, and it didn't. This is Waste Management, guys, and I don't like that it pulled back like that. That's kind of frustrating. And then I show you the ITA. The ITA is pulling back too, the defense aerospace sector. And look at Union Pacific pulled back a lot just in the last few days. I thought Union Pacific, we were getting over the whole fact that they did the merger and people were more interested in logistics. I mean, things just changed so fast. We thought the transports looked so great, and then the Iran war happened, and now they're not that popular, right? And then look at Home Depot in this trading range that they just can't get out. It might be a decade till they get out of this trading range. Home Depot. And Lowe's traded very similarly. They're like a pair trade, right? And then Visa does not look good, surprisingly. I mean, you would think that the Visas would always hang in there, but look, the stock chart doesn't look great to me. And then Wingstop, I mean, they had this blue support line that I had drew that kind of shows it slowly going up over time, and Wingstop, the fast food chain or whatever, I mean, that Wingstop stock broke down here. I think it looks really ugly. Again, not a trader. I don't own the stock today, Wingstop, but I have been interested in this stock, and I'm not touching it here. But look, it could go down to 152 as a support line. Wingstop was always very expensive. Like Kava, in my opinion, was always expensive, although I own Kava. A lot of these smaller baby fast casual or fast food joints that are like newer, they're not the old names like a Wendy's and McDonald's. Those other new franchises that have formed, they always used to trade at very high valuations for some reason. Look at Ecolab, really pulled back here, which is surprising. Look at Rollins. Rollins does all the, I can't think of the name, when they come to your house and they do everything, but pretty much it's like animal and insect control type of stuff, right? But Rollins is a great business, great stock, and it really pulled back a lot here in the last few days. And then look at MP Materials, really pulled back here. I thought the U.S. government and MP Materials was going to get us refined rare earths. Well, whatever happened to that? And then look at Roper Technologies. Someone asked me what Roper does. I mean, just look it up. No offense, but Roper Technologies, it used to be one of the stocks that I remember looking at it in 2016, 2015, 2018, just thinking, wow, this stock just never goes down and it might never go down. But it went down, guys. It's down like 40% or more from the highs. And it's just getting whacked. So, just giving you an example of what I'm seeing, why I think that if something like a Casey's or something like O'Reilly, these were examples I used that like these were the last men standing. If they start to break here, not only would I be concerned about the market and the economy, I would be interested in maybe buying some of these stocks. So it tells you how concerned I really am. Thank you guys for watching. I hope the microphone works out today. Monday morning, I'm groggy, I'm tired, and I don't like really prep. I just prep the charts and stuff. So hopefully you guys enjoyed it, and thanks so much.